Welcome, everyone, to our deep dive into the US stock market. Today, we're unpacking the action from January 16th, 2026, a day that truly captured the complex mood of Wall Street. Picture this: long before sunrise hits Broadway, thousands of investors are already locked onto their screens. The numbers on the Dow Jones, the S&P 500, and the Nasdaq are flickering, painting a picture of a market in constant motion, a market that ended 2025 with spectacular double-digit growth. By the time the closing bell rang, the Dow Jones Industrial Average had surged over 290 points, a solid gain of about 0.60%. This wasn't just another day of trading, it was a complex symphony. We heard the bright, upbeat notes of positive economic signals and the continued strength of the tech sector. But we also heard the more serious, somber tones of volatile business data and investor caution. At the start of the session, the broader market showed a sense of cautious optimism. The S&P 500 climbed about 0.26%, and the Nasdaq Composite was right there with it, advancing nearly 0.25%. These modest gains suggested that while investors weren't ready to dive in headfirst, they were definitely hopeful about the direction things were heading. It was a market holding its breath, waiting for the next big signal. Now, let's zoom in on the individual stories that shaped the day. Behind every percentage point, there's a narrative. The technology and semiconductor sectors were once again the stars of the show. Why? A powerful combination of excitement around artificial intelligence and strong global demand for semiconductors. Tech giants like Nvidia and their peers were riding this wave high. Money was pouring relentlessly into these growth stocks, continuing the euphoria that saw many of them hit record highs earlier in the year. It's a testament to the market's belief in the future of innovation. But the market wasn't a sea of green. There were pockets of red too. Investors were playing a waiting game, anticipating crucial earnings reports and key economic data that were just around the corner. With the Federal Reserve expected to keep interest rates steady through the first half of the year, and the labor market showing robust signs of recovery, every piece of new information was being scrutinized. Analysts were listening for even the faintest whispers from the market leaders. For instance, some banking and financial stocks experienced a slight pullback. This followed a few early earnings reports from major banks that raised some eyebrows and sparked concerns about their performance in the upcoming quarter. It's a reminder that even in a bull run, not every sector moves in lockstep. But then, a different story emerged from the industrial sector. Boeing, an icon of heavy industry, saw its shares climb more than 2%. This jump came after the release of a positive technical report related to a recent accident investigation. It showed that beyond the endless stream of data, individual company stories hold significant weight and can offer long-term insights that might otherwise be missed. This mix of gains and losses across different sectors paints a picture of a market that's highly selective, not just blindly optimistic. Let's look beyond the usual tech and finance headlines. In another corner of the market, consumer stocks were making some noise. A company like Hasbro, for example, traded more aggressively than many of its peers. This signals that capital isn't just chasing the latest tech trends. Stocks that reflect consumer spending patterns are also a powerful force. It proves that the health of the American consumer is still a major driver of market sentiment and a key area for investors to watch. So, what was the overarching theme on Wall Street on January 16th? It was all about balance. The delicate equilibrium between risk and opportunity has rarely felt so clear. Investors weren't just reacting to the red or green numbers flashing on the screen. They were digging deeper. They were analyzing the latest economic data, trying to predict the Federal Reserve's next move on interest rates, and getting ready for the upcoming flood of corporate earnings reports. They were also keeping a close eye on macroeconomic factors like the state of the labor market and global growth forecasts. All of this combined to create a market atmosphere that wasn't pessimistic, but it wasn't wildly euphoric either. The prevailing mindset was one of cautious optimism, a hopefulness tempered by a healthy dose of reality. Investors were looking for confirmation before making their next big move. As the trading day came to a close, the final numbers told a compelling story. The inflow of money into the major indices, the Dow, the S&P 500, and the Nasdaq was a clear signal. It suggested the market is entering a new, more mature phase. We're moving beyond simply chasing all-time highs. Instead, the focus is shifting to finding and seizing every small opportunity that arises amidst political shifts, economic data releases, and individual corporate stories. These indices are more than just numbers. They are the compass for the entire financial world. They don't just guide the way, they also perfectly reflect the hopes, fears, and strategies of everyone invested in the US stock market. The story of January 16th is a perfect example of a market that is dynamic, intelligent, and always looking ahead. Thanks so much for tuning in. If you found this analysis helpful, be sure to like, subscribe, and hit that notification bell so you don't miss our next market breakdown. We'll see you in the next video.